Oh yeah, thanks Wei for the intro. So today I'll be speaking about token valuation with a focus on DeFi tokenomics, DeFi token valuation, and then Carlo will be speaking about I guess focus more a little bit on the consensus layer economics. So this is the kind of the agenda of my talk today. So first, I'll just give you a little bit of background why we think this is important, what we're gonna do with today's talk, what valuation method we'll be using. Actually, you see it here already. Mainly, we're going to be using fundamental analysis and comparable analysis, which is to contrast the technical analysis that you see also people doing with kind of time series analysis. This is not something that we're going to do. We're going to mainly look at the fundamentals of the tokens. So to do that, we need to first understand DeFi protocol mechanisms. You know what DeFi stands for, right? I'm just kind of assuming, because I see a lot of familiar faces. So you have all semi in my blockchain technologies class already. So for those who don't know, DeFi stands for decentralized finance. This is a type of applications running on top of blockchain. They run kind of algorithmically, and they consist of a set of smart contracts where there are kind of preset rules to decide how the application should operate. We'll dig a bit more deep into that later. So to understand tokenomics, first and foremost, we need to understand the mechanisms of those protocols, of those decentralized financial services. Afterwards, we need to understand the business model or the revenue model of the protocols. This is key to understanding the valuation of the tokens of the protocols. So after understanding, okay, how these protocols work and what exactly their business models / revenue models are, then we can start doing the numerical analysis, doing a token valuation. And in this specific lecture today, we'll be looking into two different methods. Again, one is the fundamental analysis, where we actually look at the balance sheet, income statement of, well, the financial reports of protocols, and we're going to compare them also with traditional financial services. And then we're going to use comparable analysis, where basically we use different comparables, such as market cap to revenue ratio and so on and so forth, to look at where a token price is overvalued or whether it's undervalued. And we'll also look at the time series to see kind of the trend. You'll see all these later on anyway. So yes, so to give you a little bit of background, this is especially important for those of you who know a bit less on DeFi, I believe. Again, for those who have sat in the blockchain economics, blockchain technologies class, you should know this already very well. So the most important, or let's say the most primitive DeFi protocols in the blockchain kind of DeFi ecosystem would arguably be the exchanges or decentralized exchanges, and PLFs, which stand for protocols for loanable funds. You can also call them the lending protocols. On top of them, there are also yield aggregators, where basically, you know, the protocols collect funds from investors and then redeploy the funds to different protocols to earn yield. Okay, I understand for those of you who don't know DeFi that well, this might sound a little bit abstract, but if we draw a parallel between decentralized finance and traditional finance, it might be a little bit more understandable. So decentralized exchange, what is the parallel? What is the counterpart in traditional finance? Well, obviously, just exchanges, right? Here we list some examples. Chicago Board Options Exchange, NASDAQ Intercontinental Exchange. Well, basically just exchanges, stock exchanges, yeah, equity exchanges. And The DeFi or decentralized examples we list here are Uniswap and Curve. Those are two major DeFi exchanges, decentralized exchanges. They are also AMMs, automated market making exchanges, automated market making based exchanges. But this is, for now, this is not relevant to this topic. I just want to let you know that the way the exchange work is not really order book based as in traditional exchanges, but more kind of rule based, algorithm based. And AMM, the core of AMM is this thing called conservation function. Just to throw out jargons there, but don't worry, this is not relevant to today's token valuation topic. The second column, we have the protocols for loanable funds or lending protocols. Again, the parallel we draw here would be the banks. So I would say the banks, of course, banks do a little bit more things than actually protocol for loanable funds. Protocol for loanable funds, they're a bit more vanilla in the sense that with protocol for loanable funds, the fundamental services they provide is depositing services. So you can deposit your funds, your crypto assets into a smart contract. And then you can also borrow funds from the smart contract. So the smart contract would facilitate depositing and borrowing as well as the corresponding interest rate. So when you deposit, you get the lending interest rate. And when you borrow, you need to pay the borrow interest rate, obviously, which is very similar to the services, the fundamental services provided by banks. Well, banks, they absorb deposits from users, right? Either retail users or institutional users. And with those absorbed pool of funds, they would they can then lend the funds out, and they would charge, and well, they would first give the depositors some deposit interest, and also would charge borrowers the borrow interest. And there's a spread, not usually, actually always, there must be a spread such that the banks themselves can earn some revenue. Similarly, with lending protocols, you can see a spread between the deposit interest rate and the borrow interest rate for two reasons. Well, first of all, you would always have the funds that are borrowed out would always be fewer than the funds that are deposited in, right? So you can only lend out, the max you can lend out would be the total deposits you absorbed. You cannot do more than that. So with lending protocols, the borrow interest or the borrow revenue that the lending protocols collect would need to be then spread across the deposits, which is a larger base. So you would observe that the deposit interest will be lower than the borrow interest. That's the first reason why you observe a spread. The second reason is obviously the protocols themselves need to make money, same as banks. Banks need to make money. So there's a difference between lending interest rate and the borrow interest rate. The former is smaller than the latter. You can sit on my seat, sorry. Yeah. So, and then we have the third category, which would be the yield aggregators. As I said at the beginning of this slide, the two primitives we have in DeFi would be the decentralized exchanges and the lending protocols. Yield aggregators, we say that they're not really DeFi primitives. They're not really kind of the core, I would just put it, the fundamental financial services, but rather they sit on top of the more primitive DeFi services because they rely on other DeFi services to operate. So yield protocols, yield aggregators, they absorb funds and then they need to deploy funds to other DeFi protocols in order to earn money. So one way to earn money is to deploy the funds to exchanges, to decentralized exchanges as market makers. And as market makers, well, you facilitate market making, and you would earn a fee as a market maker. Well, actually, there's a term for this in DEX, which is called liquidity provider. So as a liquidity provider, you would earn a fee, the liquidity provision fee or swap fee paid by the exchange users. So that's one way to deploy funds and to earn some revenue. The other way to deploy funds and earn some revenue is to put money in lending protocols. So yield aggregators, they first absorb funds from different investors, from different users, and then they can redeploy those funds to lending protocols to earn some deposit interest. Okay, so again, the parallel we're drawing here, yield aggregators, what is the corresponding kind of TradeFi counterpart? Well, we say they're asset managers. We deem kind of yield aggregators as decentralized asset managers or decentralized fund managers. Well, what do fund managers do? Fund managers, they raise funds, right? And then they have a fund, and then they deploy the funds to earn some yield, to earn some return. But at the same time, the fund managers, how do they make money? Why are they providing this service? Well, because they charge fund management fee, right? They charge management fee and performance fee, actually, usually fund managers. Same as yield aggregators, they would also charge a fee for managing your funds. So when they distribute return, when they distribute yield, they would usually retain a portion of that yield into the protocol as a kind of revenue making scheme, which we'll then discuss a bit later. So the examples we list here, yield aggregators. Oh, I forgot to just quickly mention, let's quickly go back to the lending protocols. Lending protocols, we have two examples, Aave, Compound. In traditional finance, we just list some banks, use Citigroup, Bank of America, Wells Fargo. And then in the yield aggregators / asset managers column, we have TradeFi examples such as Berkshire Hathaway, Morgan Stanley, BlackRock. They all manage clients' funds. And then in the DeFi world, we have Yearn Finance and Idle Finance. Those are also very well-known major yield aggregators in DeFi. So far, so good. Do we have questions? I see quite some messages on chat, or is it all? Oh, okay. Cool. Okay, great. So yeah, that was the background. So what is the motivation of us looking at the valuation of the token? Well, for obvious reasons, we want to make money. Or not really, but at least we give a guidance to investors, right? To let them know, okay, whether this investment is driven by kind of hype or whether it's driven by intrinsic value, which is why in this particular lecture, we focus on really the intrinsic valuation, the fundamental valuation instead of technical valuation, instead of technical analysis. Again, what is technical analysis? Technical analysis, for those of you who did financial mathematics related degrees, you might know kind of time series analysis, gauge, this kind of analysis, right? You look at time series, you can kind of predict because you believe that the current market, the current information in the price can predict the price trend of the future. That's kind of the fundamental assumption of time series analysis, of technical analysis, right? Where with fundamental analysis, we don't look at the price, we don't look at the historical price at all. We look at the fundamentals. What are the fundamentals? Well, basically the cash flow, the revenue earning capability of an entity. And in traditional finance, when you do fundamental analysis, you basically, again, you look at the financial reports of the of companies. And here with DeFi, we also look at financial reports a bit more difficult to get than in traditional finance because it's still very unregulated, but still we can gather some information either from online information aggregation portal, or actually we can do some on-chain analytics ourselves to understand the cash flow of protocols. So yeah, that was the motivation of token valuation, to understand whether a specific crypto asset is undervalued or overvalued. We observe specifically, we observe that astonishingly there are a lot of DeFi protocols, they almost function completely identically, right? Have you heard of vampire attack? Well, vampire attack is basically forking another protocol, right? You do not have any innovation at all with regard to protocol design, but simply because, especially on Ethereum and a lot of other public chains, the projects are all open source. You can actually see the contracts deployed on chain. So it's very easy to just have an exact carbon copy of an existing protocol. It's very easy to do, and then you can have some kind of a scheme to also attract liquidity, attract traffic, attract clients or users from one protocol to another protocol. This is called vampire attacks. So there are a lot of vampire attacks / just kind of forking happening in the DeFi world, because it's just so easy to do. You literally just fork the code base of one protocol and then redeploy under your own name. Very easy to do. And we see that there are a lot of protocols that are doing exactly the same thing, especially with Uniswap. If you go to if you go to DeFi Llama, which is a very known website for DeFi protocols, you can see under decentralized exchanges, a lot of them, I would say, just the ballpark number, I would say more than 50% of the protocols are a fork of Uniswap. So they function almost exactly like Uniswap. But what is astonishing is that although they function exactly in the same fashion, you can still see that the token value, the value of the protocol tokens, will be massively different. So we want to understand that, why for two identical protocols you would have different kind of valuation, different market cap, and so on and so forth. This requires us to look a little bit deeper into the operational level, into the revenue earning capability of the protocols. Okay, I hope it all makes sense. So far, so good. That was the motivation, background and motivation. So now let's dive a bit deeper into exactly how each of these protocols function and how they make money. So the first one we have, so this one, so this one is just a generalized model for all DeFi protocols, and later on we'll look at the specific revenue models of different DeFi categories. So the general model is basically an investor come in or users, but mainly if they interact with DeFi, they want to make some money. So the investor come in, and then they deposit some funds or provide liquidity into a smart contract. So for those of you who are unfamiliar with how smart contracts work, they are very much like a externally owned address, in the sense that smart contracts can hold funds. They can also send and receive funds, but the only difference is that they are not derived from a private key. So if the algorithm is not pre-written in the smart contract, it is not possible for anybody to directly access funds into a smart contract and send this somewhere else. Also, because it's not derived from private key, nobody has a key to nobody can sign as a smart contract itself, because it's just not possible. But otherwise, it can. It's in the Ethereum, in the kind of contract or address balance mapping, the address can be either an account address or a smart contract address. So I'm saying that just so that you can understand a smart contract, you can see it as a legal entity. If we're trying to draw a parallel, I want to be careful here because DeFi protocols do not want to be do not want to get trouble from the SEC for one thing, but I just want to draw a parallel here for the sake of understanding. So if we consider, you know, an account address as a natural person, then we can consider a smart contract or a protocol as a legal entity or a legal person, so to say. So they can still they can do whatever a natural person can do, basically. So they can hold assets, they can hold liquidity, and so that's the supply side of the market. And then they have the smart contract to hold assets and manage the assets. And the user, this is the demand side. The user would come in to get, you know, whatever service that the financial service protocol or the DeFi protocol actually provides. And when the user comes in and use the service, they would need to pay some kind of fee, right? So once they pay the fee, part of the fee would go back to the supply side of the market, and then part of the fee would go to the DeFi treasury. So go to the protocol itself, go to the legal entity itself, because the legal entity provides this nice infrastructure to match the supply side and the demand side. So obviously they also want to earn some money, charge some money in between. Right? So we say that you know, the DeFi world is kind of disintermediated and so on and so forth. We don't have any third party, but in this sense, you still have an intermediary. The intermediary is, strictly speaking, the intermediary here would be the smart contract. The smart contract intermediate or mediate between the supply side and the demand side of the crypto ecosystem, DeFi ecosystem. Can I go down? Sorry, am I stuck? Oh, great. Okay. So that was so that was just a generalized view, right? So now we are looking at the specific revenue making schemes of specific DeFi categories. The first one we're looking at is DEXs. Just get all the animation. Oh, sorry. Yeah. So here we have the two primitives: the decentralized exchanges and the lending protocols. So DEXs, the liquidity providers or the supply side of the supply side of the market would provide liquidity, right? In this specific case, I put DAI and ETH, or strictly speaking, should be wrapped ETH as a ERC20 token, but let's just say ETH. So the supply side, the liquidity provider, will provide a token pair for the traders, for the exchange users to come and trade, right? So the exchange users can come and trade. For example, they have some DAI and they want to buy some ETH, they will come to the liquidity pool and sell DAI into the liquidity pool and withdraw ETH from the liquidity pool, or the other way around. Maybe they have some ETH, they want to get some DAI, same thing, they go to the liquidity pool, they sell ETH by depositing ETH into the liquidity pool and then withdraw some DAI from the liquidity pool. So that's what the user, exchange users do, right? They go to an exchange to trade, to swap one asset with another asset. But then the liquidity providers, they need to provide this liquidity pool. They need to establish the trading pair, and they need to make sure that the trading pair is supported by sufficient amount of funds. What does smart contract do here? The smart contract, what kind of role does the smart contract play? Well, smart contract, in the specific example of, you know, AMM based automated market making protocol based smart contracts, they will calculate the exchange rate automatically based on the balance of the two different assets in the smart contract. So yes, and then traders come in, they swap, but when they swap, of course, they're using the service of, first of all, they're using the infrastructural service provided by the protocol, by the decentralized exchange. Secondly, they're using the liquidity provided by liquidity providers. So they need to pay a fee, right? So they pay a fee, and the fee would be split. How do they pay the fee? Just to be a bit more exact, with Uniswap, for example, you pay for example, with 1 ETH, you could theoretically get 2,000 DAI, but the protocol will not spit out 2,000 DAI to you. They will spit out 2,000 DAI minus 20. So you would get 1,980 DAI, and the 20 DAI will be retained into the pool, and it will be some would be distributed to the liquidity providers in the end, and some would go to the treasury. So that was for decentralized exchanges, and now let's go to lending protocols. So lending protocols, again, we mentioned that already. They function very much like just like a normal bank, retail bank rather. So the liquidity providers, they come in to deposit some crypto assets into a liquidity pool, or we can also call it a liquidity pool, a lending pool. Well, this and then we shouldn't call it traders, actually we should call it borrowers, and then the borrowers would come in to borrow some assets from this liquidity pool. Now when the borrower wants to repay the loan that he or she borrowed in the first place, some interest would be accrued, and the borrower would have to pay the interest fees, and that fee again will be split between the lenders or the depositors in the first place, and also some would go to the treasury. Then we have the yield aggregators. So the yield aggregators, as mentioned, they're different from decentralized exchanges or lending protocols in the sense that they're not really as primitive as those two categories, because they actually operate on top of those protocols. They need those protocols, those more primitive protocols, to function. So the investors, users come in to put their funds into the smart contract, or a vault that is actually again a smart contract, and then the vault would have some algorithm to say, okay, what this particular vault or this particular fund's trading strategy is, or this particular fund's investment strategy is. So this investment strategy can be, providing liquidity in a decentralized exchange, or providing liquidity in at a lending protocol, or some other kind of staking yield earning strategy. And then after once in a while, the smart contract might harvest or farm the yield, and then they would redistribute part of the yield to the original investors, and then part of yield would go to the treasury of the protocol. So that's all for the business model. Any questions so far? And or from the audience? Oh, already, that's a lot. Yeah, please, Lorenzo.
You give a bit more details on how is managed the counterparty activities, maybe on
yeah, sure. Well, there's no real counterparty risk for exchanges, right? Because there's no real counterparty. Well, there's this concept of impermanent loss, because when you provide liquidity, well, at the beginning you might provide let's say 2 million DAI and I don't know, 1,000 ETH into a liquidity pool, and as time goes, the balance of the liquidity pool might change because the price of the ETH would change, right? So you would have that. You would have this thing called impermanent loss because the makeup of your portfolio is passively changed, you know, by the exchange users, by the traders. Passively changed because they would always come in, they would always dump tokens or crypto assets with less value, and they would always extract tokens with more value from the liquidity pool. This would cause impermanent loss. So the exchange users, the liquidity providers, indeed, they would gain some fee, but because the makeup of their portfolio previously was 50-50, you know, value weight is 50-50, but as the time goes, it's not 50-50 anymore. It becomes previous is 50. It's always going to be 50-50, but it's always passively rebalanced because the crypto asset, the side of the crypto asset with lower value that is depreciating will always be rebalanced to match the crypto asset, the side of the crypto asset that has more value. See what I mean? So you have impermanent loss. This is again, how is that exactly tackled? Well, actually, the way that's been tackled is exactly through fees. So you just need to dynamically adjust the fees to tackle the impermanent loss. Maybe when the pool gets a bit more imbalanced, the fees can be charged a little bit more. Some of the protocols are already implementing that, a dynamic fee mechanism. A lot of protocols are still using the vanilla kind of the same percentage fee. And to be honest, liquidity providers are suffering from impermanent loss. So to answer your question, there's a way to handle this, but it hasn't been handled very well yet, and we still see losses from the liquidity provider side. For lending protocols, how do they handle counterparty loss? Actually, I skipped this because I thought it's not very relevant to token valuation, but now that you asked this, we can expand on it a little bit. Here, this should be lending protocol, not DEX. So to be able to borrow, you would need to deposit in the first place. So that's why that's how you can borrow with the lending protocols, because unlike banks in traditional finance, you also have credit-based borrowing with DeFi lending protocols. Though there's no credit-based borrowing, there's only collateral-based borrowing. So every single loan you have must be over collateralized by the deposited assets that you have. So yeah, so if you do not pay back your loan, you would not be able to withdraw your deposits in the first place. And also, even worse, if the value of your deposits go down with the passage of time due to, just due to market movement, or due to, interest accrual, the interest accrual of the borrower would be faster than the interest accrual of your deposit, then through the passage of time, your position might get more and more under collateralized. If that's the case, and you do not top up your collateral or you do not repay, the protocol, the smart contract itself, will trigger this liquidation mechanism. So your collateral, your deposits will be available for liquidation. So the entire network can come and bid for the position to repay. So that's how lending protocols handle counterparty risk. But then again, there's no measurement that is 100% safe. It's exactly like with DEX, you have the fee mechanism that handles impermanent loss, but again, it doesn't cover 100%. Same here with over-collateralized lending and over-collateralized borrowing and liquidation mechanism also would not cover the risk 100%. You might still have the case when, if your collateral's value, in a very, very extreme case though, if your collateral's value goes down to zero just all of a sudden, then as a user you wouldn't be bothered paying back your loan, right? And also the market user, they wouldn't be bidding to pay back, because the collateral is the value at zero anyway. But that requires very careful underwriting from the side of lending protocols. So the lending protocol, they will actually underwrite the deposit assets. They would determine the collateral factor of the deposit asset. So if you have, if you deposit 100 DAI, how much value of loan are you allowed to take out? You might be able to take out, let's say, 80 USD worth of loan. But if it's some other token, if it's a more volatile token, and you deposit $100 worth of that token, you may only be able to take out 20% of that loan, so on and so forth. So that's so you have over collateralized borrowing, liquidation, and underwriting to handle these risks. Yeah.
That percentage set up dynamically, automatically by interaction with the people?
No. No, not really. Oh, well, they can adjust once in a while, but it's very, very, very slow. We actually have a research article on this. I don't know if you know, AutoGov, where we seek to adjust this kind of more dynamically, but at the moment it's not done dynamically. Yes. Oh, sorry. The question was the risk parameters such as collateral factors. Are they adjusted dynamically? I assume based on market condition and so on and so forth, or not? Not really. Although when it's the same. I guess it's the same as risk rating. Moody's risk rating. It's not continuously adjusted, but they do adjust once in a while. They do adjust once in a while if a token becomes really from a high value blue chip token into into a so to say shit coin, they would consider through usually with lending protocol, through some kind of voting governance mechanism, lower the collateral factor, or sometimes just take it out completely. You're not allowed to, or you can still deposit, but you're not getting any interest rate, or it cannot be used as collateral at all. Yes.
Just go to the next slide.
Oh yeah, sure.
Thanks. The yield farming, would you just repeat that piece again, please? So is that the liquidity providers on the yield farming?
You have first let's just get one step back. So in the previous slide, you see two ways of earn money in DeFi, right? One way is to provide liquidity and earn this exchange fee. The other way is to deposit and earn some deposit interest or lending interest. Sometimes one way is more profitable than the other. So I guess with yield farming protocols, some of the smart contract can do it a bit more dynamically for you. So all you need to do, instead of handpicking or instead of managing your funds, all you need to do is to deposit funds in the smart contract, and they can select a strategy for you, or they can do some more sophisticated strategy. For example, sometimes you need to do I'm getting a bit, it gets a little bit too detailed. Again, it's probably not tightly related to token valuation, but just to give you a bit of background. Sometimes with lending protocol, if they airdrop or distribute protocol tokens as a reward, sometimes you need to build up your position to be eligible for more reward. Sometimes what they do is that they borrow. They deposit and then borrow, and they use the borrowed funds to deposit again, and then up their deposit position, and then borrow more, and then deposit and redeposit. So they really augment their position to be eligible for more and more governance token reward. And that's, you know, on Ethereum, that's something that's extremely gas intensive, right? Because on Ethereum, you need to pay a fee. So it's not worth it for retail users to do these kind of sophisticated transactions. So the smart contract would deal this for you. So for example, does that answer your question?
Not exactly.
No.
Farming, yeah.
Oh yeah.
Sorry, I was referring to yield farming specifically.
Mhm.
When we talk about yield farming, I would say that is basically what the liquidity provides.
That's
This scenario, where does yield farming fit into that asset management?
well, when you provide liquidity to all these, the yield aggregator or the yield farming protocol itself does not provide yield. They have to rely, which is why I say they're not the primitives. They have to rely on more primitive protocols. So they have to go down to all the other, to, you know, lending protocols, decentralized exchanges. They need to redeploy the funds. You know, it's like a fund manager. They don't provide return themselves. They have to reinvest into more basic kind of projects and then get return from them. Does that answer your question? Okay. Okay, thanks. Anything else? Good. Yes.
Do these protocol DeFi where to invest in yield farming protocol? They decide where to put the.
That completely depends on the smart contract algorithm. It's exactly this question, I guess, if you translate into a question to be asked in traditional finance, it's like you're asking, how does a fund manager decide, you know, which company to invest in? It depends on the fund manager, kind of. So they're very, very specific. So some of them would be very vanilla. They would just deposit in lending protocol, very vanilla. But then you would say, I would just deposit in the lending protocol myself in the first place. But no, because with the lending protocol or with the exchange, it's the transaction might be a little bit more complicated. It might be a bit more gas intensive in the sense that you deposit in, and then they need to issue you a proof of certificate token, like an IOU token, and so on and so forth. So it might be a more complicated transaction. So it might save more gas to just put money in a smart contract, although the strategy is very vanilla, or sometimes the strategy is not vanilla, is like, you know, you're doing spiral lending and so on and so forth. I think what you're getting into is there something a little bit more complicated, you know, using some kind of mathematical modeling prediction to see, oh, which pool has the most yield. Theoretically, yes, I think people are looking into that. Practically speaking, if you go to all these yield farming protocols, they're not that sophisticated for various reasons. One is just that the yields are very volatile, very difficult to predict, and secondly, it's also very gas intensive to get all the kind of, well, it's just computationally quite intensive to get all the on-chain information. And if you frequently do this kind of liquidity, we call it liquidity hopping, which is, you know, jumping from one pool to another pool, although you can observe immediately, oh, this pool has slightly higher yield than this other pool. Theoretically speaking, if there's no market friction, you can do liquidity hopping. But then again, with the Ethereum ecosystem, I think probably easier with other ecosystem with lower fees such as Polygon, but especially with the Ethereum system, which is the largest DeFi ecosystem, this is not commonly seen. So the strategies are still quite vanilla, as a matter of fact. Does that answer your question? Yes. Good. All right. Okay, so what else? Yes, so here here it's just some historical data illustration. So we have the revenue of different protocols superimposed with the market cap of different protocols. Interestingly, one might think that the revenue or the performance might lead the movement of the market cap, but actually it's not the case. It seems that the users or the supply side of the protocols, they seem to be reacting to kind of market cap. You can see that the market cap goes up first, and then more users will be using kind of Uniswap to drive the revenue up. Same with Aave. Here also, yes, Yearn as well. So it's just interesting. But overall, you can see a very high correlation between those two time series. Here, I want to give a caveat of Uniswap. Uniswap, what we display here might not be super accurate, but we display Uniswap because Uniswap is really the largest, one of the largest at least, and most commonly known DeFi protocol out there. But Uniswap is very, very peculiar because Uniswap has also been kind of under the watch list of the SEC, and they want to determine, okay, whether the Uni token is a security token or not, so on and so forth. So up till now, if we go back real quick to look at the business model of DEX, although Uniswap has a lot of fee revenue, up till now they haven't switched on this route to divert some of the fee to the treasury. So actually, the fees from Uniswap, they would completely, so the traders' fee, they will completely go to liquidity providers, and there's no fee that goes. I just checked this morning just to make sure I get the latest information, but as far as I see, there's no fee that goes to treasury yet. So the protocol itself is actually not really making money. We still analyze in this session. We still look at the performance of Uniswap, but you need to take it as a pinch of salt because the revenue that we are showing here is actually just the entirety of the fees. We use that to kind of proxy the Uniswap revenue. But as a matter of fact, Uniswap revenue is just 0.000. The protocol itself is not making any money yet. They're being also extremely cautious because they don't want the Uni token to be deemed as security, because once you put some fees into the treasury, that goes to a bit of legal aspect there. I'm not a legal person, so I don't want to go too deep, but based on the discussion on governance forum, one of the concerns is exactly if you start to give token holder benefits and so on and so forth, would this Uni token be deemed as security, and would the project get into trouble? So that's why the discussion of whether to switch on, diverting fee to Uniswap treasury is still an ongoing debate. But it seems later on we'll see from the charts, it seems that it does not really affect Uniswap, the Uni tokens, the value itself. It seems that investors, at least, or the market sentiment is that although there's no fee that goes directly to the treasury, but they see that Uniswap has a good revenue generating potential because it has a lot of traffic and does make a lot of kind of sales. It does have a lot of swap volume. So the Uniswap token price is still quite high, but we'll get to that later. I just want to let you know that there's actually no protocol revenue for Uniswap as of yet. So that was actually part one. Let me see how I go with time. I think we need to rush a little bit, but that's okay. So we understand now, I guess, the revenue model of different protocols. Now we just need to plug in first of all, have an overview of the valuation methods we have. Those are nothing are kind of invented purely from within the DeFi world. Everything has existed in the TradeFi world for a long time. So we're just borrowing the traditional classic valuation models from traditional finance, and then to also value DeFi protocols, and then we also compare them with the valuation of traditional stocks in the traditional finance. Speaking of which, I think connected to what I said, whether uni token is a security token or not, although we need to be extremely careful with the wording, I think to some extent, especially when we do valuation, you can deem actually probably you must deem the protocol token as a share of the protocol, because at the end of the day, if you own 100% of the protocol token, that means that you own the protocol and you can completely kind of steer the development of the protocol. So again, we deem that as the parallel we draw here is protocol token and company share. So which is why we're doing this comparison here. Okay, but that does not necessarily mean that all protocols are securities. I just want to make sure, because we got to be a bit careful here with the legal aspect of things. Okay, so we're going to use two methods. One is the intrinsic valuation method, where we actually look at the fundamentals of protocols. Basically, we examine the financial reports and we look at the historical financial data of different protocols, and then we use a relative valuation method and look into multiples such as price to sale ratio and so on and so forth. Here, fundamental analysis, a bit of math here, but quite trivial. They're just a basic valuation method. So the general idea here is that we're just using NPV. Do you know what NPV stands for? If we don't, then yes. Oh, thanks. Good. So I think it's okay then. We can go very quick with this. So basically, we just calculate the net present value of the protocol by looking at the cash flow of the protocol. So where does cash flow come from? Well, that's exactly why we talked about the revenue models in the first part. The cash flow comes from the demand side of the financial services. The users, they come in, they give some fee, right? They come in, they use the service and they pay some fee, and that fee forms the cash flow, right? So we have the cash flow, and then we also have it needs to be time discounted. We have I think we have a discount rate. We approximate it based on literature and also from just the general sentiment that we collected from public information of about 25%. I think for the traditional finance, we probably use a different number. I need to check the paper. But yeah, generally the idea is to look at the cash flow cash flow here with traditional finance specifically is basically the revenue generated with the protocols and then discounted to get the net present value of the protocol. But the problem with the DeFi protocols is that although you can observe the revenue, it's difficult to observe the expenses. What would be the expenses? Well, the reason is the revenue is all generated on chain because they are decentralized financial services. Fundamentally, they operate on chain. But the problem is the expenses are off chain, right? The expenses are off chain in the sense that the protocol foundation, they write some code, the developers write some code. There is a protocol marketing team, they do marketing on social media, on Twitter, on LinkedIn, and all of them might be paid a salary in fiat. So it's not completely on chain. So you might see the treasury being drained by a certain amount, and then it's used to pay various expenses. But it's not. It's once funds leave the blockchain, we don't really know where they go. So it's very difficult to know what the expenses are. So again, it's just a approximation. It's just an estimation. We say, okay, protocol expenses are probably 20% of the total income. It's extremely it's not very accurate. It's just mainly for demonstration purposes.
I have a question.
Yes.
So do the protocols also incur gas fees when they're paying their liquidity providers? when they're moving funds back to
Yeah, that's a very good question. Yes, you need to fund smart contracts with gas. That's a very good question. Yeah, you need to, because when the smart contract, when a transaction is triggered, when the transaction is sent from a smart contract to another, it would need to be paid by the smart contract. But sometimes this fee is being completely borne by users, but sometimes again, it depends on the exact mechanism. But oftentimes the smart contracts themselves need to be funded for them to trigger some kind of transactions. That's specifically true for yield farming protocols. When the yield farming protocols, they extract funds from users, and then they need to do some kind of automatic yield farming operations. That would then the gas fee would incur, and you need to fund the smart contract. You need to deposit some ETH into a smart contract for them to work. Otherwise, the transactions would fail. Good question. Okay, so fundamental analysis here. Yeah, we look at the financial reports of DeFi protocols. Here we look at here we have the decentralized exchanges, Uniswap curve, and then we have compound Aave as lending protocols. We have yearn finance, idle finance as yield aggregators. Again, I reiterate, you see Uniswap value is large mainly for two reasons. One is that we are using really just the entirety of fees instead of fees being diverted to treasury, because that does not exist. Otherwise, you will see 0, 0, 0, 0, 0. But then secondly, also Uniswap, at least at the early stage, was also larger than Curve. And now I think Curve is actually getting more traction now. But in any case, we can see the earnings of different protocols. Here, compound Aave earnings mainly from the fraction of the borrow interest income. Yearn, idle, their earnings mainly come from fund management fee, basically. And then we also have traditional finance. Here in traditional finance, we also have here Intercontinental Exchange, NASDAQ, Chicago, and then here we have, those are the exchanges. We then will use those data to compare, the valuation between traditional finance and decentralized finance with comparable categories. And then we have to compare with lending protocols. We have some big banks, Bank of America, Citi, this Wells Fargo, and then for yield aggregators / fund managers, we have here Berkshire. I forgot MS. What was MS? Morgan Stanley, thanks. And is that BLK? Is that the BlackRock? Barclays or BlackRock? Because that's BlackRock. Yes, thanks. Yes. So that's so those are just the numbers. The numbers we got from, I think we got from Wharton Business School, CompuStat, I believe. I don't think a lot of the students should have access to the data. UCL has a subscription. So here is the fun part. To answer the question, overvaluation or undervaluation? Valuation method number one, which is to use the discounted cash flow, right? You have the revenue, you discount them. Of course, you need to have revenue, and then you need to deduct the expenses. Again, this is all just estimations. The expenses are just estimations. Revenue we can observe on-chain. Expenses are estimations. So do take these numbers with a pinch of salt, like I said. So we discount the net income, and then we get the PV, which is the present value of the net income. Calculate the terminal present value as well, and then we get the total present value of the protocol. With the total present value of the protocol, this can be deemed as the fair kind of market cap, and then we use this fair market cap based on fundamental analysis. We use that to divide. That's divided by the supply of uni token, and then we get the quote unquote the price, fair price. And then we can see the uni market price is 5, whereas the fair value we calculated, again, quote unquote fair, because the numbers are not exactly accurate, but just for illustration purposes, we can still see that the overvaluation is tremendous. Again, remember that actually these revenue are overestimated, remember, because Uniswap actually doesn't have any revenue. Uniswap revenue is 0, 0, 0. We are actually just using the entirety of fee to proxy the revenue, but still you see uni market price is just extremely, well, 5 times the fair value that we estimated.
The supply includes both vested and unvested. So there must be an event where you are not all. There may be a schedule of this.
Yes. Yes, I think actually we use the total diluted. I think we use the total.
That's the gap that we said.
Yes. I need to check. I think so. I need to check, but I'm trying to think. Yes, I think so. Yeah. I think I would. Well, why would you differentiate between the token that's been vested and the token that's not being, like, why would you say the tokens that are vested have a value of 0?
I would take
Exactly. So that's what I'm saying. That's the entirety. So yeah. And so this, if you do market price, so market price times this supply, it will be the total diluted market. So that's what I'm saying. Yeah. And what else? Okay, then curve, right? Curve. We have curve as well. Similar exercise. We calculate. Well, the revenue will be fetched just from with on-chain data, or we actually didn't process ourselves, but we got the data, secondary data from this website called Token Terminal. That when we did the exercise last year, they still only have a handful of protocols, DeFi protocols and layer 1 protocols, but now they're getting much more comprehensive. So again, we have the revenue data, workforce expenses estimated, then we get the net income calculated, PV, the cash flow, and then we get the total present value. Again, we have the supply, total supply divided, total present value divided by supply, get the number 0.72 compared with the market price at the time of data retrieval, which was end of June. So we can see that actually curve was relatively okay, at least at that time when we were doing this estimation. It seems that curve was mildly, slightly under, but then it's extremely sensitive, right? The workforce expenses are estimated, but it seems it's in line with the quote unquote fair value that we calculated. And then we have Compound and Aave, the lending protocols. We can see that the lending protocols are even much crazier. Here, if we see, okay, the exchanges, not under, not over, correctly, more or less correctly priced, Uni 5 times overpriced, then you will see here Compound and Aave, the lending protocols, massively overpriced. So you can see that the fair value was around 8, 9, and the market price back then was 47. All right, and then here we have, again, if you compare 8 versus 57, again, also we see a massive overestimation, valuation of the tokens. Here we have the yield aggregators. Yield aggregators look relatively okay, moderately okay compared to the lending protocols. Lending protocols are craziest, but the yield aggregators, you can see the valuation in line with the market prices, relatively in line, in the same order of magnitude, at least. Not like lending protocols, they're not even in the same order of magnitude. Yield aggregators the same order of magnitude as the estimated fair price. So that's with, again, like I said, that's with discounted cash flow, discounted income, PV'd income. Here we compare with traditional finance. We use almost well, we used identical kind of method so that we can compare apple with pear, apple with apple, not apple with pear. We can compare apple with apple. For exchanges, it seems that traditional finance is more mature, and the overvaluation is less prominent. Well, you know, with Intercontinental Exchange, even small undervaluation. Nasdaq, again, same order of magnitude, 90 versus 150, not too bad. Chicago, 90 versus 110, also relatively okay. Lending protocols counterpart, which would be the banks. Also, we even see that Citigroup, it seems that Citigroup was undervalued, so 120 versus the market price of 50 back then. And then Bank of America, very similar value to the estimated fair value. Wells Fargo also very similar. Again, the interpretation is that the traditional financial world is more sophisticated, more efficient, and the investors, market sentiment, the investors in the market a bit more rational than the DeFi investors. Last but not least, the category fund managers. Okay, we can have a look. Again, not as not so crazy. Same order of magnitude. Berkshire, that was 500 versus market price 270. Morgan Stanley 100 versus around 80, and then BlackRock 400 versus 600. So again, at least in the same ballpark. So that was, I think I need to wrap up real quick. But yeah, we'll go very quickly. Comparable analysis with all the data at hand, we'll be able to do comparable analysis very easily as well. So we use two multiples to do the analysis. The first one is to use the market cap, the total market cap, divided by revenue. We already, collected the revenue data. And the second method is to use the market cap divided by net assets. We look at the multiples of the different protocols and then compare the multiple with the same category of the traditional finance, just to see, just to get a feeling. Underprice, the relative, I wouldn't say absolute, but relative underpricing versus relative underpricing / overpricing. So before that, because we're doing because we are using net asset and revenue, this and that, I thought it would be interesting to just insert a slide on DeFi accounting here. This is an ongoing project that we're doing at DLT Science Foundation and UCL together, because as mentioned at the very beginning, it's become easier and easier due to regulation, compliance, and so on and so forth. Much easier to get data from traditional finance, companies from traditional finance, especially listed companies, right? Due to regulation, you can get, especially US companies, you can get the data from Edgar very easily. You can get their financial reports. With DeFi, there's simply no standard. It's more difficult to get financial reports. So this ongoing project is just to really look into individual transactions and map them into with double entry accounting journalization to understand, okay, each time when a transaction comes in, what goes where, right? So if you borrow a token in a lending protocol, how does it affect the asset side and liability side of the balance sheet of the protocol, and so on and so forth. I wouldn't go too much into detail here, but just to show you, this can be done, but it needs to be done really with great care and on the case-by-case basis, as different protocols indeed function differently. And these are the things that we actually do need also for the service providers out there. We actually do not know how they parse the transactions, but because it's kind of a black box. Even Token Terminal, it's not specified very clearly how they parse, how they actually get the data of revenue, but there are ways to do it. It's It's just a lot of on-chain transaction parsing going on there. So again, just to go back, we use the two multiples, market cap divided by revenue, as well as market cap net asset ratio. So here, there's an overview of the results. So above, you will see the result of the first multiple, which is market cap revenue multiple. And I know it's very difficult to read, but I'll read it out loud for you. So the dashed lines, these lines, the dashed lines are DeFi, and the solid lines are TradeFi. So you can see that the DeFis are massive. We also plot a time series. You can see that DeFis are relatively overpriced compared to TradeFi. You can see that TradeFi are all below when we compare the multiples. And again, below we have another multiple, which is market cap divided by net asset. And we can see again, relative, this is also, you can see the most crazy one is the lending protocols. This also in line with the other valuation, actually corroborates with the other valuation result we saw with the discounted cash flow, right? You remember with discounted cash flow, the PLF, the lending protocols were the most overvalued. You see, market price 47. Whereas the revenue is only 9, and here market price 57, revenue only. The discounted cash flow, PV discounted cash flow only 8. So actually corroborates with that result. You can see that with either method, lending protocols are massively overvalued. With decentralized exchanges, a little bit more mixed. We can see. Okay, Uni in this particular case, market cap divided market cap asset ratio seems to be within the range of other multiples of the traditional finance. And here with yield aggregators, it seems that year-end finance is more overvalued compared with idle. Idle seems to be a bit calmer. But then with the other multiple comparison, both of them are above, but then it does go down. Yes, that's also a trend we see, especially with exchanges and yield aggregators. We see a little bit of a downward trending. It seems that investors are getting a little bit more rational with the passage of time, and the most overvaluation, at least for DEX, occurs at the beginning of the sample, and also for lending protocols also at the beginning of the sample, although with this other valuation, it seems a bit more flat. But yeah, that is all. I think that's basically the idea of this session is to, first of all, for you to understand the mechanism of different protocols and the revenue business models of different protocols, and then use this knowledge to do a more fundamental valuation as opposed to technical valuation, technical analysis. And the conclusion is that at least back then, that was 2022. I think the market has gone down even further afterwards. Back then, we see a massive overpricing of decentralized finance protocols. And again, the market has adjusted itself and went down since then. Still very little research into valuations of tokens, but I will give you 2 references of our research papers that you can read, and tokenterminal.com for those who are interested in this particular topic. As mentioned, they are doing good stuff with fundamentals, token fundamentals. A year ago, when we started to look into this topic, they only have a handful of projects now, but now they're getting big. And but again, this kind of business is not very scalable. I was speaking to one of the conference attendees who also want to do some valuation, but was saying that it's very difficult to compete in this area, as these really need to be, the fundamentals of a particular protocol really needs to be kind of manually parsed on a case-by-case basis. It's not something that can be mass processed as of yet, because you really need to understand the revenue stream. When you look at the transaction, what goes where, you need to understand, okay, which is the treasury, account, and whether this particular transaction means, in the generalization, where this particular operation, this particular fund flow is an income, or is it something else, or is it just somebody injecting funds into the treasury account? This is all very, at first glance, all very unclear. So it needs to be parsed on a case-by-case basis. So yeah, last but not least, those are the references I've used to compile the lecture, to compile the slides. Questions? Thanks. Let's have a look. We still have a bit of time. Questions? Offline, online, yes.
I can ask one.
Yeah.
I spent a lot.
Of course.
In DCF model, no,
Yeah.
You mentioned that the lending protocols are
Yeah.
very much overpriced.
Yeah.
When you look at the market.
Yeah.
So have you tried to also look at what is the growth rate the market would imply? Because if you tune the growth rate, you can go back. You start from the market cap and try to match the growth with a given growth.
Oh, I see. Yeah.
So,
Yeah.
Like I was curious whether you try to actually match it and see what the growth rate expected.
Right. No, okay. No, we didn't do that, but that's interesting. So yeah, the growth rate is actually an input, and then we actually, that's a good point. We actually use this. Did we use? I'm trying to think. Actually, we did use the same growth rate across different categories, which might have affected the result a little bit. But then again, we did the same thing for the traditional, TradeFi companies, and for TradeFi, the banks are not so in comparison, not as crazily overvalued. Yeah, but yeah, no, it's the same as with Black-Scholes options. You can calculate implied volatility. I guess we can assume the market price is just the right price, and what is the implied growth rate? This is something that's to be done. Yeah, thanks. Yes, then yeah.
Earlier you said that within yield aggregators that people put inside of Ethereum so that it could be used for distributing funds to different.
They could put Ethereum in, yeah.
But
Ethereum can you also use it for paying gas, but sorry. Go ahead.
yeah, like the paying gas one. But I thought that only accounts that can pay gas.
No, you can. The smart contract can also transact and pay gas, but you need to. They need to be pre-programmed, though.
Oh, okay.
Yeah, they also smart contracts. If a transaction is initiated by smart contract pre-programmed, they also need to pay gas.
So they can sell it.
Well, how would you say self-execute? Well, if it's pre-programmed, then the event triggers it to execute, then yes, then it executes by the smart contract, well, per smart contract logic. Yeah.
Do you know the impact of the first, when you deploy the token, I would say we take the first liquidity pool, and how influence this balance between the two tokens can be in the valuation, the short and the term? If it's completely off balance from the very beginning, if this can have impact on short and the mid-term valuation.
Well, sorry, what is off balance at the very beginning?
The first one.
Yeah. Oh,
This one is
yeah.
completely wrong.
Sorry, the first what?
Liquid pool.
The first liquid, you mean for exchanges?
Yes.
Or, okay.
Yeah, for example.
Yeah.
When you create the first one, and this one is completely arbitrary.
Oh, you mean the the pair you create, the initial implied price deviates massively from the market price.
Yeah, I don't know if this has an influence on the long-term or mid-term valuation or not.
But why would you do that? Well, nobody would do that because like I said, then as soon as you provide the liquidity, arbitrages will come in and drain the more valuable tokens out, right? So it's highly recommended. It's even warned by the user interface that you shouldn't do that. But to answer your question, if you do that, then it's going to attract a lot of arbitrages. A lot of them are bots. They look into arbitrage opportunities. They see that, oh, your price massively deviates from the market price. Yeah, they would come in, and at the beginning you will see a lot of transactional volume. But I don't think any rational liquidity provider would do that unless they do it just to attract transaction volume, wash trading. I don't know, but as a rational liquidity provider, you wouldn't do that. Yeah. Well, not emptied, but rebalanced such that the pool would still display a price that's equivalent to, well, that's more corresponding to the market price.